Welcome to video 4, where I go over chapter 4, job order costing. This chapter is the first of 3 chapters that go over inventory costs. Chapter 4 goes over job order costing. Chapter 5 goes over activity-based costing. And chapter 6 goes over process costing. Now that's a lot of material on determining the cost of inventory. But it goes back to in chapter 1, where I talked about controlling costs. Managers spend a lot of time trying to figure out how much things cost because they want to control it. In fact, so much managerial information is used to control costs that sometimes managerial accounting is called management control. For example, there's an academic journal called Journal of Management Control that focuses almost exclusively on managerial accounting topics. In this and the next 2 chapters, we talk more about dividing up costs based on their location. Maybe thought of a better way, dividing up costs based on who is responsible, who or what is responsible for them. That's really what we're doing when we're determining the cost of inventory, is we're saying which product units are responsible for which costs in the firm. Because then we can match the cost of those inventory units to how much we're able to sell them on the market and determine how much profit we're making from each inventory unit. Once again, trying to maximize profit, we're simply subdividing to a smaller level now, to individual product units. First, I go over 3 general types of firms. Each of these firms provides some value to the customer, but in different ways. First, we have a merchandising firm. Now, it might seem, if you're not thinking very carefully about it, that they don't provide that much value to the customer. They're simply buying goods from one place and selling them somewhere else at a markup. But ultimately, they're providing convenience and accessibility to the customer. Convenience and accessibility that they might not otherwise have. For example, think about the last place you went grocery shopping. Now, if you didn't have the grocery store there, having all those goods in one place, how many trips would you have to take? How many different stores would you have to go to? Would you even be able to find some of the items? Likely answers to those are that you would have to go to many more stores, spend a lot more time shopping, and you might not be able to find some of those items, especially those that have to be shipped from far across the world or across the country. Service firms offer to do something for the client. Often they're providing some sort of expertise the client doesn't have, and usually they aren't dependent as much on the physical products that the client takes home with them. Now, manufacturing firms are the focus of these next 3 chapters, but a lot of the things that we talk about still apply to service firms and to a lesser degree, merchandising firms, much lesser degree. Manufacturing firms usually have something that they're doing. That can include something that's electronically based, but they're still creating something. They take some sort of raw material, implement some sort of process to convert the raw material into something else that customers value more than the raw material. A manufacturing firm wouldn't be a manufacturing firm unless somewhere along the lines they made a process further choice in the seller process further decision. That's what manufacturing is, processing some raw material further into some new good. Now, in the chapter, I take some time to talk about merchandising firms, and I apply some chapter 3 principles to them. I'm going to skip over that. Let's talk about traceability now. If we don't understand the idea of traceability, then we're going to have difficulty with the following definitions. Again, these are definitions like in chapter 3 that you probably have heard of before: direct materials, direct labor, overhead. But if we don't lock down the definition and understand how it relates to traceability, then we're going to be in some real trouble when there are some ambiguous cases, or there are some cases in which you have to use some real judgment to understand whether this is a direct material, direct labor, or an overhead cost, especially when we start having different systems in chapter 4 here, in chapter 5, in chapter 6, in chapter 8, where we deal with overhead in different ways. So we need to have it locked down. And so in order to trace down a cost's location, we often use physical proximity. Was the person nearby working on the engine block across the assembly line? Then that person's labor might be traceable to that engine block. Was this material literally attached to the engine block? Then yes, that's probably a direct material that we can trace to that engine block that it was attached to. Sometimes this doesn't exactly line up, especially in the modern company that's often distributed across a large geographic area. You can still find some sort of a trail that lines up this work being done on behalf of these product units. So, I don't talk about cost object the same way that a lot of textbooks do. It's not a bad term, but I don't think it's really necessary for a lot of the stuff that you have to do and understand in managerial accounting. There really is only one cost subject that's worthwhile for the vast majority of things, and that is the individual product unit. So we're asking ourselves, can a cost be traced to individual product units? That's the first question. And that will determine whether it's a direct cost or an indirect cost. If it can be traced to individual product units, then it's a direct cost. If it cannot be traced to individual product units, it's an indirect cost. Now, when I say can and cannot, the threshold we're talking about is whether it's economically feasible to, not whether it's metaphysically possible. Sure, we could probably trace every single drop to individual product units if we wanted to, every drop of oil that goes into the machinery. But would that be economically feasible? Absolutely not. Almost in every case. So we're talking about costs that can economically be traced to individual product units. And so that's often why these are sometimes fuzzy categories. One company might find a particular cost to be direct because they're in a very tight market or they have a large market share, and so they are very competitive about their costs. So they are willing to exert more energy in tracing costs down, and they have a different threshold for what's economically viable as far as tracing costs to individual product units. Whereas a smaller firm or a firm that's maybe in a little bit less tight of a market is fine just saying, I'm not going to exert the energy. It'd be a waste to trace XYZ costs to individual product units, so it's going to be an indirect cost. There's a separate question that we can ask. Can we trace costs to particular product lines? If we can, then they are a product cost of that product line. If we can't account for a cost as being incurred for sake of a particular product line, then it's a period cost. Now, when we're in a manufacturing firm, we can simply take manufacturing and replace it for product. So we have our manufacturing costs are simply product costs in a manufacturing firm. Costs that can be traced to a particular product line in a manufacturing firm, and non-manufacturing costs are simply period costs in a manufacturing firm, costs that cannot be traced to a particular product line. So in this case, when I say trace to a particular product line, we get some good examples of overhead that cannot be traced to individual product units, but is still traceable to that product line. So we have, for example, a shift supervisor's salary. This is a great example of overhead. The shift supervisor performs a lot of responsibilities and does a lot of things across the line, the assembly line, across the factory. And his or her salary is certainly associated with the product line or product lines that are being manufactured in that factory. However, it almost certainly is not economically feasible to trace that shift supervisor's time to individual product units. He or she's probably working with the workers who work with individual product units. And is the shift supervisor economically and realistically going to track his or her time with individual people and then also match that to individual product units that those people are working with? In most cases, when we're talking about a manufacturing setting, the shift supervisor's salary is an indirect cost, even though it is a product cost. So now we get to my diagram here where I have these two key questions that I ask. First of all, the direct versus indirect question. Is it traceable to product units, to individual product units? If yes, then it is a direct cost. This rectangle right here is the direct costs. If no, then it's over here in this larger rectangle, which is indirect costs. And we have a second question that I asked, is it traceable to product lines? If yes, then it's over here in this bigger rectangle, which is product costs or manufacturing costs if we're in a manufacturing firm. If it cannot be traced to product lines, it's in this smaller, thinner rectangle right here, period costs or non-manufacturing costs. Like I said, we have names here. So I gave an example of overhead. It can be traced to product lines, yes, so it is a product cost, but it cannot be traced to individual product units. Nope, not a direct cost. Right over here, it has to be an indirect cost. So it's a product cost that is indirect. Likewise, we have our direct material and labor that is product costs, of course. They are product costs, and they are direct. We can economically and reasonably trace them to individual product units. At the other end, of course, we have our SG&A, standing for Selling, General, and Administrative Costs. Sometimes you just hear this as general and administrative costs. Sometimes they have other terms for it, but the general idea is the same. These are costs that really you can't trace to individual product lines. They're indirect, and in fact, they're period costs, non-manufacturing costs. Now, the next three chapters differ primarily in how they deal with this rectangle of product costs. Start from the idea that product costs need to be associated with the product. that is responsible for them. That's easy when they're direct material and direct labor. In most cases, that tracing is done just by tracing it to individual product units. With some exception, in Chapter 6, we'll change how we do even these traceable product costs in Chapter 6. But generally, if we can trace it, it makes sense to trace it. The big problem comes from overhead. Overhead, based on the idea of absorbing costs, all product costs into individual product units, should probably be a part of the cost of each individual product unit. How much overhead goes to each individual product units? The next two chapters, job order costing and activity-based costing, have two different answers for this. Now, I love my animation down here. The idea is that we have overhead floating around the product. The outline here of the sponge is the product. And inside the product, we already can trace direct costs to them, but we can't trace the overhead around them. So we're just going to let them absorb somehow some of that overhead cost. And the rationale that we use is going to differ from costing philosophy to costing philosophy. We're going to use some rationale to put some of these overhead costs into the product, even though they're just happening around the product. For example, the shift supervisor salary. The shift supervisor has some sort of an indirect relationship with the individual product units coming along, the assembly line. But really, we can't trace how much. So we're going to take some of his or her salary and put it into the individual product units. So with job order costing, I like saying it this way. Some textbooks actually shorten it to just job costing. I like having job or order because I think it helps you understand what it is. So we're talking about areas where it's customizable, at least to some degree. Like I said, in Chapter 6, we'll deal with direct costs differently. We're going to kind of average them out over all the products produced in a period, because in Chapter 6 with process costing, we're going to talk about products that are interchangeable. We have 1 million marbles coming across the assembly line just this hour. Do we really need to stop and name and number each marble? No, we just have a big bin of marbles. So we're just going to divide marble direct materials cost across all of them. It gets a little more complicated than that. That's why I have 3 different videos I'm going to do on Chapter 6 to walk you through the individual steps. But in job order costing, we have started the opposite assumption that we have individual jobs that are unique and are special. And so, yeah, we're going to name them. This is the Kaczynski job, or we're going to number them. This is order number 324. We're going to spend time to individualize the job or the order, give them a name or a number, because they're going to be different. They aren't marbles that are going to be largely homogeneous across the product, but they're going to be special in a way. We're going to have certain costs that we incur for the Stasinski job that we don't incur for the Kowalski job. We have certain costs that we're going to incur for the order 324 that weren't ordered for order 325. So each job is going to vary. That's when we would use job order costing. It's the job or the order. If you can give it a job name or an order number, and it makes sense to do that, it's likely that the jobs and orders are customizable enough that you should use job order costing, or at least that's one of the paradigms you could use. Now, to do this, what we say is we're going to assign a cost driver, one cost driver. Job order costing, we use this cost driver, and we're going to say it's something that we can trace to individual product units. It could be direct labor hours. It's a very common one, very easy example to use. It could also be direct labor costs in dollars. It could be machine hours, miles driven, or other measures, any other measure that you can directly trace to an individual product unit, and that you can reasonably say this ties and associates with how much each individual product unit is responsible for overhead. So we're going to say, okay, we don't know that shift supervisor's salary, how much of it is due to this individual product unit, but we know that that shift supervisor spends the majority of his or her time working with direct labor. And so there's an approximation based on direct labor hours that are spent on each individual product unit of how much of that supervisor's salary each individual product unit is responsible for. And so in that case, we could use direct labor hours as a cost driver, because we can trace that to individual product units. Direct labor hours, the name direct here means that by definition we can trace it. Otherwise we wouldn't call it direct. If it's direct labor, we can trace the hours to individual product units. And so therefore, in the example I just set up, we can piggyback overhead onto our tracing of direct labor hours to individual product units and say we're going to charge those product units a certain overhead charge, a predetermined overhead rate based on the direct labor hours that those product units consume. So that's what we get down here, PDOH rate, predetermined overhead rate. I may sometimes omit the rate when I say that, just say PDOH, just accidentally, but I mean the same thing. There's no confusion there. If I say PDOH or PDOH rate, it's always referring to the same idea, PDOH rate, which is budgeted overhead costs over the budgeted cost driver. So it's all happening beforehand, predetermined. We want to, in job order costing, we want to determine a PDOH rate before the period's even started. So we have our budgeted numbers of overhead cost for the period, and we have our budgeted cost driver. So let's say, for example, we have a $50,000 salary for our shift supervisor. Little example here, that's the budgeted overhead, $50,000. And we expect there to be 500 direct labor hours that are spent during the period. So we have 500 down here in the denominator. That would lead to a PDOH rate of $100. 50,000 over 500 should be $100 over here, the PDOH rate. And so as these jobs and orders come across the assembly line, we're going to charge them this PDOH rate as they consume direct labor hours, because we've assumed that the direct labor hours are an approximation of how much responsibility those product units, those jobs, or those orders, how much responsibility they have for the supervisor's salary. It's overhead costs we can't really trace to them. We're going to use an approximation of how much responsibility they have. So in this example, we have custom cars, and I used custom cars for a reason, because there's no doubt that these cars are something that we would want to give individual job names to or individual order numbers to. So we have our budget for the next year, and we know we are budgeting $5 million in overhead costs for the next year. Budget machine hours is 50,000. So we have now our PDOH rate of $5 million of budgeted overhead cost divided by 50,000 machine hours, our budgeted cost driver. So we can have $100 per machine hour, our PDOH rate. It doesn't always have to be $100. My two examples have used $100 thus far, but it could be anything, depending on your budgeted overhead and your budgeted machine hours, or your budgeted cost driver. So we have an individual car, it's a custom car number 125, and it came across the assembly line, and as it came across, it used 200 machine hours. We had to devote 200 machine hours to it. And so because of that, because it incurred that much of the cost driver here that we determined, we're going to charge it that 200 machine hours times $100 PDOH rate to get $20,000 in overhead costs that we're going to charge car 125. Car 205 only uses 10 machine hours, so we only charge 100 times 10 equals 1,000 in overhead costs to it. Therefore, the overhead we apply is our PDOH rate times the actual cost driver consumption. All right, so pay attention to which ones are actual and budgeted. To create the PDOH rate, it's all budgeted. It's predetermined. You have the budgeted numbers before the period starts. You can determine the overhead rate before the period starts. To apply overhead costs, you use that PDOH rate and use the actual cost driver consumption. So I don't know before the period starts how much overhead cost car 125 is going to receive yet. I might have a budget for it, but I don't know yet how much it's going to receive. Not until I actually see the actual machine hours consumed, actual cost driver consumption, do I know how much overhead is going to be applied to car 125. And so now, like I said, we're talking about pi I. We're talking about the pi for this individual product unit. So how much profit are we earning from this product unit is how much revenue we take minus the cost of that unit, which under job order costing, we're approximating this way. The direct materials we can trace to the unit, direct labor we can trace to the unit, and then these two working together, the PDOH rate, the overhead rate that we've calculated, multiplied by the cost driver that we're using to apply that overhead. So that altogether is the cost of that individual product unit. And that helps us determine how much we're making off of that individual product unit, that job, that order. It helps us understand, make better decisions. Let me tell you a little story that might help you understand why we can now make better decisions based on job order costing. So I used to live in Pittsburgh. It's an old town, and they have a lot of old houses there that have certain plumbing problems. Plumbers are great examples of people who will use job order costing, because each plumbing job is going to be different. And so we actually had some trouble in our house. We had a main line break. The main line is the big pipe that goes, has a main stack that all the toilets and sinks tend to join, and then it runs under the house and it connects to the sewer or the septic tank, depending on where you're at. And then this main line broke. The old houses in Pittsburgh, they told us that they used to build these main lines out of about 2-foot sections of terracotta pipe held together with horsehair. And so after 70 years or so of this house, since it was built, when we were living in it, that main line was looking like a roller coaster underneath the house with all the erosion that had happened over the years. And so we had a big break, and we called a plumber, and this plumber happened to specialize in mainline breaks. And this is where the job order costing story comes in, because as we started talking to this plumber, I learned some interesting things about how he changed his business. He had my understanding is he didn't start specializing in mainline breaks, but because there were a lot of them in Pittsburgh, and because they often were covered by insurance, homeowners insurance, he found it to be his most profitable business, and so that was almost exclusively what he did. And I'm sure when he started out, if he were doing lots of different jobs, lots of different types of jobs, oh well, I'm replacing a toilet today. I'm going to be snaking out a drain today. I'm going to be installing some new shower or something like that today. This job over here has a mainline break. He would have been able to trace his costs and revenues and see how they stacked up for those individual types of jobs, and over time recognized either because he was literally running the numbers or his brain was running the numbers in the background, or it's the sense as he went along. You know what? These jobs that are mainline breaks, there are a lot of them, and I get good profit off of them. And so he was able to specialize. And the end of the story is that it's kind of funny that when the Google car came down our street, it actually came down while the Poop 911 truck from this plumber was in the driveway, and that was actually the image on Google Maps when we were selling that house. As we continue down the chapter, we're going to talk about the journal entries and inventory accounts that we're going to use in the actual general ledger to implement a job order costing system, how we would exactly absorb costs into the individual product units. So first of all, we go over 3 different inventory accounts and 1 expense account, and 2 expense accounts. And then we'll talk about how they work together. This might be a review for you, but if not, understanding the mechanics will help a lot as we get into chapters 6 and 8 somewhat. So we have raw materials. This is an inventory account that shows the dollar cost value of raw materials that have been purchased. Often I like to visualize this as being the cost of goods that are in the warehouse. You have this warehouse of raw materials, and then when you are going to put them into use, you have a forklift or a truck, take them from the warehouse over to the factory. Factory has a bunch of work in process. Dollar cost value of that is reflected in the work in process account, or WIP. We have raw materials that we've trucked over. We have laborers who are working there. We also have overhead costs from the factory that are part of work in process. Once they're done, they're going to move, I like to visualize it as them getting on another forklift or another truck and moving away from the factory to the showroom floor. They're finished goods, they're going to go on the showroom floor, and the dollar cost value of those goods that are on the showroom floor are shown in finished goods. Now, once they're sold, they go to the people's homes and they become sold. Costs of goods sold then needs to reflect their dollar cost value. Now, this next expense account, the overhead account, is a special expense account, and it's used to help us balance the applying of overhead through a PDOH rate. So, as we have our overhead rate calculated already, we had $100 as our overhead rate before in CAR 125, used 200 machine hours, therefore it was applied or was charged $20,000 of overhead in our example. What we would do is we would debit work in process, because the car is in process right now, $20,000. It's an expense, we're debiting, so we're debiting work in process, $20,000 for the value of overhead that comes from those 200 work hours, 200 machine hours of our cost driver. At the same time, we're going to credit overhead control for $20,000. It's 1-to-1. Now, this overhead control account allows us to take our our applied amounts on the credit side. Here are applied amounts, and balance them against the actual overhead costs that we incurred. So, for example, we have various overhead costs that are going into that numerator for the PDOH rate. We're budgeting certain amounts for supervisor salaries, for factory costs, for machine maintenance, things like that. As we incur those costs, actually, they get debited to overhead control. Like I said, overhead control is an expense account. So we are debiting it when the actual overhead costs are incurred. As those costs are leaving out the back door through the PDOH, we are crediting the overhead control account. And so that's just right here. They're leaving out the back door to go to the inventory, the work in process that we were applying the costs to, and we're crediting overhead control. But those two don't line up. There's no rule making them line up. The predetermined overhead rate was determined before this period started, so it's not going to include any sort of unexpected either savings or overages in our actual overhead costs. So when we get down to the T account, and down here, this debit side could be much higher or much lower than the credit side. And so we have to do some special things when we close out the overhead control account. And so now we can have over-applied or under-applied overhead. We over-apply the overhead when we've put out too much overhead cost through the back door that is actually coming in on the debit side of this expense account. And so here is that we've over-applied $1,000 in this example. We would under-apply the overhead if we haven't yet used up all our costs that we actually incurred and applied them to, used up is the wrong word. We haven't applied all the costs we've actually incurred to individual product units out the back door here, and so we have a balance, debit balance in the trial balance. That would be an under-applied overhead. And so we have to close it out. Like all expense accounts, I have this, fun little thing I say. I talk about saving the world and how we're saving the world every month because accountants are closing out all those expense accounts that have to be closed out. And overhead controls and expense accounts, we have to close it out, and we can do it one of two ways. We can close it out directly to cost of goods sold, COGS, or we can close it out ratably to work in process, finished goods, and COGS, usually based on the number of product units that are represented by each account. So first of all, we just go directly to COGS. In this case, we would have a journal entry that debits overhead control by $1,000, because that would put $1,000 over here on the debit side, and the trial balance then would be $0. We close it out. We would debit overhead control for $1,000 in this example, and then we would credit cost of goods sold, which makes sense. Cost of goods sold is an expense account, so it goes up with the debit. We're crediting it because we had over-applied our overheads. We've got to reduce the costs that we applied and recognized in our expense accounts by $1,000. Now we could ratably meter them out, those $1,000 out, to WIP, finished goods, and cost of goods sold based on how many product units are in each account. So let's say, for example, we have 2 units that are still in process, so there are 2 units represented by WIP, 2 units that are finished, but they haven't been sold yet, so there are 2 units represented by finished goods, and then we sold 6 units, so we have 6 units that are represented by cost of goods sold. Now we can now say that we have 2 out of 10 units in work in process, 2 out of 10 units in finished goods, and 6 out of 10 units in cost of goods sold, because overall we have 10 units, 2 plus 2 plus 6. So we have 2 out of 10, 2 out of 10, 6 out of 10. And we can simply multiply the $1,000 by each of those fractions to get it out to the different accounts. So 2/10 times $1,000 is our credit to work in process. 2/10 times $1,000 is our credit to finished goods. 6/10 times $1,000 is our credit to cost of goods sold. And then we're still debiting overhead control. The overhead control side is going to be determined by the trial balance of this account. It's always going to stay the same. It's just which side it is going to differ based on whether we over-applied or under-applied. It's the other side of where those costs are going, either to apply more costs because we under-applied, or to reduce the costs because we've over-applied. It's where those costs are going that differs, and we fractionally meter it out based on product units in each account if we're using this method right here. Now here are some useful terms. We have cost of goods manufactured, cost of goods available for sale, and of course cost of goods sold. We should be familiar with that one. I'm going to skip over this. You can read the textbook if you like. I also have this animation that goes through an example of how the costs flow through from raw materials and labor costs going over to work in process. We have a plot application of some overhead control, and then at a separate time we have the overhead control, the actual overhead costs being incurred, and it goes through the entire setup. Lastly, in this chapter, we talk about department PDOH rates, because sometimes in the example above, for example, the custom car example, I skipped over the part where in the paragraph I said, last year the firm used direct labor hours, this year it's using machine hours. Sometimes there's some debate. There are ultimately multiple cost drivers you can use, which are, one, traceable to individual product units, and two, reasonably approximating the relationship between overhead and the cost responsibility for overhead in individual product units. And so each department, perhaps in some settings, will want to choose a different cost driver for its overhead costs because of how its department's relationship between overhead and individual product units stacks up. And so you can have these individual department rates based on different cost drivers, based on different budgeted overhead, based on different budgeted cost driver consumption for the upcoming period. And so you end up with each individual product has a profitability of its sales price minus the direct costs right here. And then you have overhead applied to each department that touches it, that has a cost driver that gets consumed by it. So actual cost driver for department 1 consumed times its PDOH rate, actual cost driver for department 2 consumed times its PDOH rate. I like to end the chapter talking about department rates because it sets us up well for chapter 5. So that's it. Bye.